You need to understand what Freddie Mac has just proposed because it is coming. What did Freddie Mac just do? They just talked about releasing or buying second mortgages. Why is this important? Well, according to Meredith Whitney, it could unlock potentially $1 to $3 trillion. And folks, if we've learned anything over the last couple of years, releasing that kind of money into the system is going to reignite inflation. We're going to have this conversation with Convoy Home Loans, Dustin and Jonathan. Guys, what do you think? Second mortgages, is that coming?
It's I mean, we think it is because obviously second mortgages up until this point have kind of been privatized, right? Whether it's with the bank or whether it's with, Wall Street funds or whoever that offers, those types of loans. And like you said, reignite inflation. It's almost as if everyone is just on the same page about trying to do things to stimulate the economy,
Yeah.
And every move that everyone's talking about to stimulate economy leads to higher inflation, right? Which is the number one enemy of the Feds right now. So it'll be interesting to watch how the reaction is and how it actually passes and goes into play. Because if you remember 2 years ago, or a year ago, we were talking about FHA 40-year fixed mortgages that
I
were
remember.
and everyone was freaking out about that too. They were like, we're going to get 40-year fixed mortgages. And we were like, that's not the case, right?
Yeah.
I feel like, I hope it's not kind of the same thing where this actually does allow, I think, a little more liquidity to happen. But at the same time, it's not going to be for everyone, right?
Yeah, the thing that I think about this, guys, is the Fed and Jerome Powell. He sees this headline and he's saying all kinds of cuss words in his head. These mother blankers, blah 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 blah. Because again, right, he's trying to get his foot on the brake to stamp out inflation. And then you got Freddie Mac over here, another government, I don't know, entity or whatever you want to call it, basically unlocking the tap. It's like, what are you guys doing? You're not on the same page.
No, it doesn't, obviously help Powell's stance and what he's trying to communicate to the markets. But there's always that battle between, the markets and the Feds and your average consumer. But, the biggest thing that I think John and I discussed last week when you sent us this was the fact that we know that Fannie and Freddie or any of these, government sponsored entities, FHFA, VA, et cetera, they're always 1, 2 years, maybe 3 years late to the party on what Wall Street is trying to roll out or what we on we'll call it non-QM side, always try to get, in front of the consumer first. And I don't think it's going to be something that, they're going to have a hard problem using and deploying that money if they actually do, because there's so many people right now, that are trying to get a Fannie or Freddie back second. Because right now, like John said, the only option is going the private route. And, believe it or not, the private route knows that they're only, player in the space, and they can charge a little bit higher because of that. So that should actually, I think, maybe bring the private side of seconds down in terms of rates, because now they've got competition.
Yeah, they got competition. It's amazing. It's amazing how competition works. Let's just try to put some numbers on it. I know these are not quotes. These are just rough numbers. Would it be, I'm gonna guess, you can just tell me if I'm wrong, kind of a private second today, you're probably double digits, right? 10, 11, maybe 12 on that.
Yeah.
If Freddie Mac's coming out with something, it's going to be priced lower. It will likely be single digits, right? Probably still 9, but single digits. Is that reasonable?
Yeah, absolutely. I don't think it's even crazy to say that it might be in the 8 with an 8 handle. Because obviously it'll be full income qualifying. There will be their own little measures, but I think 8 handle is pretty realistic. And just because I know that they also don't want to, they're a conventional product. So they're not going to be bumping up the rates 2-3 points above, maybe at match prime or something like that, right?
Yeah. I like it. And then the other thing a lot of people might be wondering is, why are these institutions doing this? And I don't think a lot of people have the insight that you guys have. They're starving, right? They have built businesses on doing loans. And we have had transactions south of 4 million for quite a while. And if you take out the cash buyers, it's even less of that. So these institutions want to keep the paying the bills, if you will, overhead. So they have to create a new product. And frankly, they created the market, right? We had 3 years of low rates. Everybody's fixed. Now everybody's locked in. They got to keep the lights on. So this second product will help them do more business, correct?
Yeah, absolutely. I mean, and the Fannie and Freddie government sponsored entity, they're a business too, right? And every business has to deal with innovation and trying to find a new way to survive in the new market. And like I said, they're a little bit late, but it's something that I would be very surprised if once they rolled it out that they would have issues getting any sort of demand on that money.
Is it fair to say, again, I'm a complete outsider of this part of the market. Is it fair to say if Freddie Mac makes this happen, that FHA and VA will just quickly follow suit, or is that not a good assumption?
I think they'll try, right? And the reason I say try is because typically everyone that does FHA and VA is higher leverage, right? Meaning
Okay.
higher LTVs. So there may just not be enough room for a lot of those people to be able to tap into that, equity.
Okay.
What I imagine happening is, people with an FHA can't get a Freddie or Fannie Mac second. I assume that it's probably going to be like you have to be in a Fannie Mae or Freddie Mac owned loan to do a Fannie Mae, Freddie Mac, whatever second
Correct.
loan.
Mhm.
So it can't be a mix and match. FHA, VA, again, typically those people are buying with 3.5% or even 0% down. So
Good
I
point.
don't assume that they'd be able to come into market with an aggressive second. And if it
Okay.
does actually come in the market, I mean, they currently still have like down payment assistance programs available, which is technically kind of like a second loan to help buy properties.
Mm.
So I don't think that they rush into the market to be able to do that because their people are different, right? The people
Yeah.
that they're trying to market to is different.
I like that. I like that. Wise advice. I love having you guys on the show. You see around the corners. So I appreciate that. I am curious, right? When you look at your entire book of business the last year or so, how many conversations or what percentage of conversations were about equity extraction? Right? Because that's really what we're talking about here with Freddie Mac is equity extraction. Were a lot of people looking to do that? Was it more or less than you thought? I mean, what's going on? What are people looking to do today?
Yeah, I without actually having the hard data in front of us and running the numbers. Now, keep in mind, our numbers might be a little bit skewed because a lot of times we are dealing strictly with investors, and a lot of the
Sure.
investors that come to us are getting out of some sort of bridge, hard money construction
Mm,
loans. Naturally, they're getting equity extraction because of the new ARV compared to the purchase price that they got.
mhm.
That probably skews our numbers. If we threw that out, though, and we were only talking about refis from an existing loan where they didn't do any rehab to the home or their primary residence, I wouldn't say there's more than in that class that I just went over,
Yeah.
20% of the refis probably trying to get some sort of equity extraction. But then overall, our book of business, the amount of cash out refis we're doing is still probably close to 40 or 50%.
Okay. Yeah. The reason I ask is um, the more and more I play with this, just given got to be a Freddie Mac first, right? To get a Freddie Mac second. I think about, the max LTV at 75%. So they're putting in the right kind of guardrails. So we don't go back to our houses being an ATM machine and take it up to 100. Um, I don't know, man. I think this Meredith Whitney call of $1 trillion of liquidity coming out by the summer, by August is I don't know that I can do the math to get there. It seems pretty wild to me.
I think the way that she's also potentially adding it in, I think they're also factoring in the fact that if rates potentially come down a slight bit, right?
Mhm.
And there's a lot of hopeful people still on Hopium that are hoping for that to happen, right? That's three
Yeah.
hopes in one sentence, right?
Three hopes in one sentence. That's the
Yeah,
hope. Yeah.
they are assuming that obviously if that happens, and I think it's no secret that prices will increase, and if there's an increase in prices, then that'll unlock more equity that didn't exist before. And I've personally called for an almost like an equal amount of equity growth potentially if rates come down from this higher point in the next 3 to 5 years, then as the same as the last 3 years, which was after COVID, right? So I think the same type
Oh,
of thing will happen
wow.
potentially. And I think if you think about that, then obviously there's going to be the math kind of then makes itself a little easier to math out.
Yeah, no, that let me just say, Jonathan, I am not speechless very often, but you just gave me the shivers. And
Yeah,
like, just think about that, right? We got 30% appreciation. Let's just use a round number the last 3 years. And I think what you said was if rates come down, let's call it 6.5, 6, you're thinking that we could see 30% again in the next 3 years? If, that's three ifs. That's if,
Yeah.
and if.
I don't think it's impossible because
Yeah. Okay.
everyone's now used to 7-8%, right?
You're so right. Yes.
And the demand is there, right? I mean, Jerome Powell really tried to slow down the market. It didn't slow down, right? So if that's the case, and we know that everyone is still wanting to buy, right? The American dream is still real. People are going to drive up prices if rates go down to 6.5, 6. We saw this actually in place when people were making crazy offers. You remember like December, January, when rates took a little blip down, like maybe 0.5%. It went from 7.5 to 7 to under 7, right? Under 7.
I remember.
And people started going crazy on the offers. And they were writing offers that were, again, kind of reminiscent of right after COVID times, with the prices being 100, 200K over asking, right?
Wow.
And listings that were sitting stale, we're starting to get offers again, which means that people are willing to pay more for properties that they weren't willing to pay for before. So now we're going to run to that. I think we're going to run to that same situation over the next 3 to 5 years, which again, then there's more equity for if you buy right now, right? Which is what we're doing, buy smart deals right now. You're going to be able to take advantage of that equity gain, but at the same time, everything's going to get more expensive. We're headed towards that route.
Yeah. I mean, I just did a keynote presentation up in Portland over the weekend, and I tried to communicate both to the room and also the private VIP section that we need to be hoping for rates staying in the sevens, so the market could slow down and it could heal itself. If, to your point, we suddenly take a big spike to 6.5 because unemployment jumps to 4.2 or something, things can get bananas again. It really could. And I hope people realize that. Just keep doing the work, do great deals. I guess the other thing I wanted to talk about with you guys is the commercial market. I still think commercial lenders are largely out, like commercial banks are largely out. I think a lot of them, if you guys hear from billionaire Barry, right, Barry Sternlicht, he says we're going to have one bank failure a week through the rest of the year. I think that's a little high, but we will have more bank failures because their balance sheets are in tatters. If they over-indexed on San Francisco office, for example, you can't come back from that. So we have a lot of pain coming to some of the commercial lenders. Are you guys hearing in the tea leaves about more stress in the banking system, or not really?
Yeah, I think it's a two-folded, parted question for me and John, particularly to answer. As everybody knows, we do focus mainly on the residential side. Now we have a commercial division that does everything commercial, but there is a little bit of a overlap between the lenders that we use on the residential side as well as the commercial side. And we actually have seen more so of the lenders that we believed were going to get hurt on the commercial side just because of and I'll take a step back. Like when you're doing a commercial loan, right, the lenders and the underwriters are going to base this simply off of the cash flow to determine the value, right?
Correct.
It's a lot easier to cash flow when rates were at 2 or 3 when they got these 5-year fixed notes in 2020 and 21. But now all of a sudden we can see, as we saw in the San Francisco office space that you just alluded to, values on $100 million property can get cut in half to 50 mil.
Oh,
right. And when you get a loan that was at 60% LTV on 100, and now all of a sudden the property is worth 50, what do you think is going to happen? It's a big problem.
I know exactly what's going to happen. Here's the keys, Mr. Bank.
Yeah. But the residential side doesn't have that problem, at least,
Not
right?
today.
We still underwrite the value, at least on sales comparisons, not using the cash flow to determine the value. But to go back to your initial question, I do think there's a lot more hurt, and I feel bad for those that are strictly in the commercial space on their side than in the residential, because the residential banks and lenders have kind of weathered the storm. We've went through it, we know what's coming, we've priced it in even up to 9-10%. We've seen how it's rebounded. And ultimately the investors on the residential side feel a little bit more comfortable lending on residential than commercial right now.
Yeah, and you can really see that in the spreads. I mean, we talked earlier in the year, maybe it was last year, spreads were like 310 basis points. Now they're like 270, 265. So even the
Mhm.
spreads are coming in and rates are getting better.
You know, that can go to our next. I mean, we literally had
yeah,
this happen exactly what you just brought up about a week ago when we were at 4.7 end of April, and now
yeah.
that we're at 4.4, but our margins and our spreads. I mean, you can go on
Yeah,
the
so
top of-
I mean, you can talk about the residential side. I just want to talk about 30-year fixed commercial. Like, so up to like 9 units right now, what I'm seeing more than before
Mm,
is, especially in the smaller balance market, that
yeah.
properties like 9 units below that 5 to 9, I guess, that don't fit inside the Fannie Freddie
Hmm.
box, right? And then
Yep.
they have to go bridge loan or something, right?
Mm,
For those people, I'm seeing a lot of them actually revert to our products of a residential loan, the
hmm.
DSCR, just
Okay.
because they can lock into a 30-year fixed at maybe like commercial apartments are like maybe 6.25, 6.5-ish right now
Yeah.
on a
Hmm.
5, 7, or 10 year. They're all pretty much the same because of the inverted yields. But
Hmm.
we're seeing a lot of these, like, 9 units, 8 units start being underwritten on a 30-year fixed side at,
Nice.
like, I don't know, high sevens, right? And you're trading off 1.5%, but you're trading off 1.5% for one fixed, right? Fully amortized or interest only, or you're also trading it off for the certainty. Because if
That's
something
exactly right.
happens
Yep.
in the market where the banks are starting to do what we're talking about, and it's like bigger picture stuff, right? Where you're looking
Hmm.
past the current status of the market, where, hey, I can actually get maybe a 1.5% less if I go with a bank at Fannie Freddie and do 60% LTV, or I can just do maybe 65 or 70% LTV with this non-traditional product, but I
Yep.
can lock in for 30 years so that I can make sure that no matter what happens in the market, my property is not affected, and I
Yeah.
can calculate out what it would be going forward. And if rates drop 5 years down the line, then great. You're ecstatic, because then you just go back to what you were doing previously. But if the
Hmm.
market continues to be volatile, because we don't know the true effect
No.
of which property and asset types will be declined from commercial lending going forward, right? Because of the kind of the waves of what's happening. So I've seen a lot of people lock in with us on a 30-year fixed note under $1
That's
million
good.
to show up to 9 units on
I like it.
at like high sevens, which is not a bad deal, right?
No.
Especially you're still cash flowing very positive, but you have that sense of certainty and you're looking at a bigger picture. Like, I know that the rates higher I'm getting right now, but at least I'm not betting on the market to be better in 3 years or 5 years, even if because if you have to go to a bridge route, it's 2 to 3 years max, like on a commercial. So after that, what are you going to do if the market's not improved?
Yeah.
Right. So this allows you to kind of still lock in on the longer term. That's what I've been seeing a lot, actually, going to that topic of the banks failing, just because
Yeah.
we're moving over for a little bit leverage on our side.
Yeah. No, I think that's very wise. I mean, if you're an investor out there and you have a 5 to 9, I know I certainly would go get 30-year money. I've been in environments where the term comes up at the wrong time. There's people now going like cash in refis, right? We like to talk about cash out refis, not cash in refis, and that's coming in a big way to a lot of commercial brokers. If somebody wanted to reach out to you guys and see what's what for their situation, how should they do that?
Go to convoyhomeloans.com and let us know you came from ORAT. And then we just wanted one more thing on
Go for it.
DSCR for the
Go for
one
it.
to fours that Dustin can go into.
No, it was basically end of last week. Everybody was a little bit scared just because of, were we going to get to 5 on the treasuries? Were we going to get
Yeah.
to 4 to 8, 4 9? And it was kind of a good timing for us, because when we saw it cross 4.7, we tried to negotiate with our investors that buy our loans from us on Wall Street and said, hey, we need to get the spread down between the rate that we offer and where the treasuries were at, right?
Okay.
So we got that basically reduced like 20 or 30 bips. And then, of course, the treasuries went down 20 or 30 bips. So from
Haha.
last week till now, we've basically got like a 50 basis point drop in
Nice.
rates on all of our like DSCR bank statement stuff. So it's been pretty nice for the last couple of days.
Nice, nice. Again, folks, Convoy is always investing, always looking for new products, always looking for new ways to help you. And that includes negotiating hard with Wall Street types. Again, go to convoyhomeloans.com. Let them know you came from ORAT so you get one of these two fine gentlemen. Otherwise, you will end up in a queue. Nobody likes to be in line. Let's go to the guys at top. Thank you so much. Later.
Thank you.
Yeah.